It is the 28th of June 2021. My name is David Hickson, and in today's market update I'm going to be taking a look at the S&P 500 with a quick glance at the Dow Jones Industrial Average and also the Nasdaq. I'm going to be speaking about uncertainty and how we can make clear trading decisions even when there is some uncertainty in the analysis. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. So let us start our discussion by taking a look at the S&P 500, and this is the analysis that I've been speaking about for months in these videos. The important features, as I think you can see, are the 54-month cycle trough in March of 2020, the 40-week cycle trough at the end of October last year, the 20-week cycle trough at the beginning of March, and most recently the 80-day cycle trough here in the second week of May. The implications of this analysis are very clear at the foot of the chart, because here is our staggered nest of lows for the 18-month cycle trough, which means that we are expecting an 18-month cycle trough to form in this market. And as I have been discussing in previous market updates, I am expecting that trough to form in about July of this year. So we're getting very close because it is the end of June at the moment. In my previous market update video, I spoke about my level of confidence in this analysis and mentioned that it was at the 80-day cycle level. In other words, I am fairly confident that the 80-day cycle trough formed in the second week of May, which means that we would have an average length of 68 days, which should elapse before the 18-month cycle trough forms. And I mentioned in last week's video that it seemed likely, although I was recording the video before the markets opened in the US last Monday. Here is the day on which I recorded that video. I mentioned that the evidence from overnight trading was that it was already forming a 40-day cycle trough on that day, which you can see has now been confirmed in this analysis by placing the diamonds under last Monday's price bar. And so nothing has really changed, in my opinion. Of course, the market has bounced strongly out of that 40-day cycle trough, a little more strongly than might have been expected, given that this is the final 40-day cycle in the current move down towards the 18-month cycle trough. And what about the fact that this is such a staggered nest of lows, as you can see over here? And let me zoom out again. When you see a nest of lows that is sort of spread over to the left-hand side, I imagine the locomotive of a steam train driving along the foot of the chart, and if the smoke coming out of the smokestack seems to indicate that that steam train is traveling at great speed, in other words, the smoke is leaning over to the left like that, then that indicates that this trough is overdue, and we should stand by at any minute for that trough to form in the markets. One of the problems with these market update videos is that I try to keep them short, in the recommended maximum 20 minutes for a YouTube video, and so I don't get the opportunity to discuss in great detail all of the possibilities, and I try to present only the most likely possibility in my opinion. And this is still the most likely possibility. I am still expecting price to move down into the 18-month cycle trough, but we do have to bear in mind the fact that we have the staggered nest of lows, and we need to take a look at what else might be happening in this market. In particular, is it possible that despite all the evidence in this analysis and my confidence in the placement of the 80-day cycle trough and so forth, is it possible that the 18-month cycle trough has formed in the markets? The answer is yes, it is possible. I am still expecting price to come down into the 18-month cycle trough, and as mentioned in previous market updates, I'm not expecting that to be a particularly dramatic move. But nevertheless, we need to consider what else might be happening. One of the things that I always do, and you will have heard me mention this in several market update videos, is that I always have a default chart, which is an analysis that Sentient Trader has performed that I have not influenced in any way. So all of my workspaces include a default analysis. Let's take a look at that default analysis now. There it is, and the reason that I keep a default analysis at all times in all of my Sentient Trader workspaces is because over the years it has been fairly humbling, but I have found that Sentient Trader is often right when I am wrong. And so I always keep a default analysis and I keep an eye on it. There are times when the default analysis looks a little bit wonky and it doesn't really make a lot of sense. But there are other times when the default analysis looks really very convincing. And this is one of those times. Take a look at these very neat nest of lows at the foot of the chart. You can see that the nest of lows for the trough that is expected to form in July is of only 20-week magnitude, not 18 months. So what happened to the 18-month cycle trough? Well, according to this analysis, here is the nest of lows for that 18-month cycle trough, and as you can see, it is a neater nest of lows, and it is expecting that 18-month cycle trough to occur later towards the end of this year. So for those of you who are new to Hurst cycles, this might come as a bit of a shock, because we've been speaking about an 18-month cycle trough, and now is it possible that it's only a 20-week cycle trough? Well, it is possible, and a little later in this video I'm going to explain why it does not hugely impact the trading decisions that we are making. But before we get there, let's discuss the possibilities. So what has actually happened in this analysis? Why is it that this analysis is different? The main reason why this analysis is different is because of the position of this 40-week cycle trough and also of this 20-week cycle trough. Whereas the other analysis has the 40-week cycle trough occurring at the end of October, this one has the 40-week cycle trough occurring over here at the beginning of March. So that is the difference in the analysis, and for somebody new to Hurst cycles it might seem like a really big difference and a terribly worrying thing. Which brings me to one of the important points that I would like to make in this video, which is that Hurst himself said that a Hurst cycles analysis is as much an art as it is a science. In fact, it is this aspect of the Hurst cycles approach that I find so fascinating, and I know many Hurst cycles analysts do. Many find it a little disconcerting when first they come across the idea. But let's explore what could be happening here. And one of the very important things to do is to take a look at some other markets. So let's do that now. Hurst defined a principle of commonality, which tells us that markets tend to move with a great deal in common. So let's see what other markets in the US are saying might be happening at the moment. In order to do this, I'm going to take a quick look at our Hurst Signal service, which conducts an analysis on many instruments every day. So let's take a look at the S&P 500 on our Hurst Signal service. Here is the 3-month view, and you can see the same staggered nest of lows for the 18-month cycle trough which we are expecting to form. In fact, this analysis is exactly the same as the one that we've been looking at in these market update videos, with the 80-day cycle trough over here in the second week of May. You can see that the interactions between price and the FLD have been identified, and I'm going to come back to those in a moment. There's a very interesting anomaly that has developed on this particular chart, and that is that the composite model line, this dashed orange line over here, has indicated that according to the information contained in the analysis, which is what the composite model line is, of course, the market has been expected to move down, as would be expected, into this 18-month cycle trough, which is expected over here in July. Recently, price has diverged from this composite model line, which is a reason for us to start questioning what is happening in this analysis. It could simply be that there are other influences on this particular instrument which are causing price to diverge from the purely cycle information, if you like. But that is what our current analysis looks like in the S&P 500. Now let's take a look at the Dow Jones Industrial Average. This is, of course, a closely correlated market, and here you will see a very different analysis. Well, not very different, but a slightly different analysis, with the 80-day cycle trough over here in the 3rd week of April instead of in the 2nd week of May. This, I should point out, is a fairly questionable analysis, and if you take a look at the interactions between price and the FLD, they are not very clean, they're not very obvious, and they call the analysis into question. However, we have a much neater nest of lows for the 18-month cycle trough over here. And whereas in the S&P 500 analysis that nest of lows was leaning over to the left, this nest of lows, as I think you can see, is leaning over to the right, indicating that this trough might not actually be expected quite yet. However, the composite model line, the dashed orange line over here, is showing very clearly that according to the analysis information, we were expecting a trough to form at the beginning of last week. And so this particular analysis, while not as good as the analysis we've been looking at in the S&P 500, in my opinion, does certainly warn us to stand by for the possibility of an 18-month cycle trough forming now or last week. Now let's take a look at another very closely related market, the Nasdaq. And here you can see the other scenario, if you like. We have the 80-day cycle trough over here in the second week of May, and here is our nest of lows for the 18-month cycle trough. It's a fairly neat nest of lows. The 18-month cycle whisker is off to the right of the chart there, but it's a much more balanced nest of lows. And this analysis looks fairly good. We have a 40-day cycle trough over here in the second week of June. And the composite model line, as I think you can see, is more balanced than it was in either the S&P 500 or the Dow Jones Industrial Average. And it is indicating that we are in our final 40-day cycle of the current 18-month cycle with a lower trough expected over here in July. And so with that consideration, by taking a look at a few other markets and considering different analyses, I think you can see that there is some uncertainty regarding what is happening in the analysis. I know that newcomers to Hurst cycles often find this uncertainty in the analysis disconcerting. It is unfortunately a fact of life when it comes to performing a Hurst cycles analysis. So how do we deal with it? The important thing is that we use the analysis even when there is uncertainty, to gain insight into what is happening in the markets and to make clear, sensible trading decisions on the basis of that. So let's take a look at how we would do that in this case. Let's start with the analysis that we have been tracking. As I have already mentioned, we've got this untidy nest of lows for the 18-month cycle trough. For some time we've been expecting the 18-month cycle to form a trough in about July. As I've mentioned in previous market updates, it might not be a very big, strong move down, and it is absolutely possible that that trough did form last week. Although, in my opinion, we still have another 30 days or so, or perhaps 3 weeks to go until that 18-month cycle trough is going to form in the markets. So how do we make a clear trading decision, even on the basis of an uncertain analysis? This is where a trading strategy is really important. A trading strategy is simply a means by which you make clear trading decisions on the basis of your analysis. As you know, a trading strategy that I enjoy working with is the FLD trading strategy, which is based upon the way in which price interacts with the 20-day FLD. So here is the 20-day FLD. This is the analysis we've been tracking. And as I mentioned in my previous market update video, here is our A category interaction where price crossed up above the FLD, reached up towards its target, came down towards the 20-day FLD again and found support at the level of the 20-day FLD at the time that the 20-day cycle trough formed in the markets. That is a B category and then a C category interaction. Price then crossed down below the FLD in a D category interaction, achieved its target to the downside, formed the 40-day cycle trough, and then bounced upwards, crossed above it in an E category interaction. The point is that all of these trading decisions were very clear on the basis of this particular analysis. Price is now heading up towards a target, after which we would expect price to come down and cross below the FLD. The important point here is that we can trade that sequence of interactions between price and the FLD with confidence on the basis of this particular analysis. Let's take a look at the default analysis that I showed you earlier and consider how that analysis might have changed our trading decisions. Here is that analysis. Let's zoom in on the recent time period and display the 20-day FLD. On this chart we can see exactly the same interactions between price and the FLD. There is our A category interaction generating a target to the upside. Here is price finding support at the level of the 20-day FLD at the same time that the 20-day cycle trough forms in the market. That is the B and C category interactions. And here is our D category interaction as price drops down below the FLD, achieves its target, overshoots it slightly, and forms the 40-day cycle trough over here. Our next interaction is the E category interaction, which is of course a long trading opportunity, and we would expect price to head up towards its target of about 43.45 before crossing down below the FLD on its way down to the 20-week cycle trough over here instead of the 18-month cycle trough as we saw in the other analysis. So here you can see we have two different analyses, and yet we have effectively the same trading decisions. There are some subtle differences. In the other analysis we were looking at, we would expect the market to be turning a little more bearish at the moment, so we would be less confident about taking a long trade now. But both analyses, or at least the trading strategy applied to both analyses, result in exactly the same direction of trading. But this was a fairly easy situation where we had two very closely related analyses in this particular instrument, so it wasn't very difficult to make sure that we were trading in the right direction. What about an instrument that has a different analysis, such as the Dow Jones Industrial Average? So here we have a different analysis situation, because the Dow Jones Industrial Average, as I've mentioned, was expecting an earlier 18-month cycle trough to form. There's our composite model line showing that it could indeed have formed last week. So what are the trading decisions over here? And this is where this becomes interesting, because you can see that the trading information presented at the top of this chart indicates that the most recent interaction, that was the interaction just a few days ago, between price and the FLD, was probably a category G interaction. Now, a category G interaction is where price comes up to the 20-day FLD, finds resistance, and then drops down into the final trough. However, notice this comment in brackets. Consider an early A category trade. An A category trade is also a long trade. Would we consider the possibility that an A category trade is going to occur early in this market? I would say that we would, for at least two reasons. The first is the composite model line, which seems to indicate the possibility that a trough was going to form about a week ago. The other reason is the recent average wavelength of the 80-day cycle, which you can see has been 52.8 days. The average length of an 80-day cycle is 68 days, and so clearly it has been running short recently. When a cycle has been running short, might we expect the next trading opportunity to come early? Yes, indeed. I do hope that you found this market update interesting and useful. The idea of a Hurst cycles analysis being more of an art than a science is one that I know many people struggle with. I hope that you haven't found it disconcerting for me to present two slightly different analyses in the S&P 500, and I hope that you can see how even when there is analysis uncertainty, it is absolutely possible to make clear trading decisions which mean that you end up on the right side of the market and are able to profit from the insight that Hurst cycles give you, even when there is some uncertainty. If you have any questions, please put them in the comments below this video. I look forward to hearing from you.